Have you heard of Dave Ramsey? In case you haven't, Dave is one of the most well-known personal finance gurus out there. His practical money tips and straight-talking advice have helped millions get out of debt and build real wealth. Hello and welcome to Wealth. In today's video, we'll share 5 pieces of shocking money wisdom from Dave Ramsey that just may leave you speechless. Now keep an open mind, because some of this might challenge your assumptions on topics like budgeting, saving, investing, and more. So get ready to have some of your preconceived notions rocked to the core. Number 1. Build up a $1,000 starter emergency fund before paying off debt.
Baby step 1 is to save $1,000 in the bank. Baby step 2 is pay off all of your debt except your home, listing your debts smallest to largest. But I kept having people in Financial Peace University have little things happen. $322 alternator goes out in their car. They blow a tire, it costs $100. Their kid gets sick and it's $100 to go to the clinic. Little stuff happen. Little emergencies happen while people were broke and trying to get out of debt. And they're going to fix their car. I mean, they're going to fix the alternator. They're going to put the tire on the car. They're going to pay the clinic to take their kid, right? They're going to do the emergencies, legitimate small emergencies. And when they did those, they emotionally couldn't recover and get started again on the debt snowball. Believe it or not, what the $1,000 actually does as your baby step 1, more than actually giving you a real financial pad between you and bad luck, bad problems, bad Murphy while you're getting out of debt, is more than anything, it gives you a little bit of emotional margin.
All right, let's start off with a bang. Here's a controversial Dave Ramsey suggestion. Build up a $1,000 emergency cushion before aggressively paying down debt. Now, the standard line of thinking goes like this. If you're burdened with high-interest consumer debt like credit cards or personal loans, all extra money should go towards wiping that out before savings. After all, why stash away money earning 1% interest in the bank while you're paying 20% interest on credit card balances? Logical, right? But Ramsey disagrees. He believes having a small $1,000 starter emergency fund should take priority even when you still have lingering consumer debts. His reasoning? Reality happens. Cars break down, appliances fail, medical bills pile up. And when surprise expenses inevitably hit, most folks without cash savings will do what? Reach for more credit cards and sink deeper into debt. Meanwhile, that $1,000 stash could prevent taking on even more high-interest consumer debt. Now, is this approach optimal from a math perspective? No, prioritizing the highest interest rate debts first makes more logical sense. But Dave argues the real world isn't always logical. Unexpected stuff hammering your budget does happen. And look, $1,000 isn't an exorbitant emergency cushion target to delay debt payoff. Saving that reasonably small starter amount gives a bit of breathing room when life throws its curveballs. Once that's built up, Ramsey advises switching all focus back to aggressively knocking out lingering debts once and for all. So while unconventional, hopefully you now see the method behind Dave's madness on this first shocking piece of advice. Emergency foundations prevent derailing debt freedom down the road. Number 2. Every dollar must have a written job to follow through on your budget.
On purpose, every dollar has an assignment before the month begins, and you're in agreement with your spouse on that, and that is not a theory, it is the directive for your month. You live according to the numbers that you write down. You do not spend anything except what is written down without coming back and adjusting the budget. When you do that, you will get the stress off of your back, because not knowing if anything's getting done will drive you crazy.
Ready for another one? Dave Ramsey believes every single dollar you earn must already have a written job before the month even starts. In other words, you should budget out all income on paper ahead of time so you know exactly what those dollars will do as they hit your account. Now, most financial experts agree budgeting is crucial, but they focus more on high-level spending categories like housing, transportation, food, etc., rather than nitpicking exact dollar allotments. Dave takes things to the extreme instead. He wants every bill planned out to the penny even before that month's check arrives. Rent $1,000, gas $100, groceries $300, and so forth, writing out exact jobs for dollars preemptively. At first glance, this sounds totally micromanagey and unrealistic, right? Do people actually know to the dollar what they'll spend on food and gas next month? Isn't that what general budget categories are for? To account for life's variability? Well, Ramsey acknowledges sticking to preset exact dollar figures is tough, but he contends the act of consciously thinking through intended jobs for incoming dollars sets you up for budget success. If that written plan says you'll blow $200 on restaurants, mentally you'll try avoiding it, knowing dollars are meant for other priorities instead. It's more about the awareness gained from proactively allocating potential dollars than hitting precise targets. Writing unassigned incomes jobs in advance puts you in a deliberate spending mindset when that money actually comes in. Whereas not budgeting at all leads to haphazard spending with no purpose or accountability behind it. So while hardly anyone tracks living expenses to the penny, Dave's point is the mental exercise of intentionality and conscious spending gets triggered when you pre-budget at that nitty-gritty level. Give every dollar a written assignment on paper before the month takes off. Number 3. Invest 15% of your income no matter how much you earn.
The point is not the magic of 15% works, but if you do 14, you're going to be poor. I mean, it's not that precise. The idea is to put a large chunk, which 15% is, but not so large that you can't get your other debts paid off on your house. And that's where the 15% came from. Because when I first started this, I would have people they're putting 25% away, or they're putting 1%, or they're putting 1% away. What if you were this income and you save 15%? Would you be okay in this age? And what if you saved 12%, and if you save 17%, and if you save 10% or 20%? And we kind of went back and forth. And so what we've zoned in on is at most any age, at most any income, 15% is a good, healthy amount.
Buckle up, because Dave Ramsey's next shocking piece of money advice relates to retirement investing. He advocates putting 15% of your income towards retirement no matter how much you earn. Now, conventional wisdom states you should first build up a 3 to 6 month emergency cushion, maximize employer retirement matches, knock out high-interest debts, then start ramping retirement contributions once you have financial breathing room. But Ramsey takes an extremist route instead. He argues retirement savings should begin immediately, at that 15% level, even if you're still paying off debts or barely getting by. At first glance, this seems totally backwards, right? Why decline putting extra money towards debt payments or emergency savings in order to invest for the far-off future instead? Well, here's Dave's reasoning. He believes undersaving early on is the #1 reason most Americans enter retirement age broke and dependent. Since time in the market drives portfolio growth exponentially, starting early at any income level is crucial. Essentially, Ramsey states getting in the habit of consistently investing 15% of your income stream from the very beginning powerfully sets you up for financial independence later on. Meanwhile, delaying investing until other financial boxes get checked often means you never start, and sacrifice the wonders of compound growth in the process. Now, is Ramsey's 15% maxim unrealistic for some folks living paycheck to paycheck? Sure. But he presents the number more as an aspirational target. The point is to make retirement saving an utmost priority up front, even if you can only afford to put 5 or 10% away early on. Because in Ramsey's words, no matter how much or little you make, investing 15% will put you on track for a secure retirement. The power of compounding works its magic most strongly the earlier funds get in the market. So while shocking, hopefully you now see the method behind Dave's aggressiveness on investing. He understands time as people's most precious asset. Number 4. Pay cash for cars, even if financing is cheaper.
Average millionaire drives a 4-year-old car with 41,000 miles on it, and of course it's paid for, and they haven't had car payments in decades, which is how they became a millionaire, because the average car payment now is over $500, about $504 a month over 84 months. If you invest $504 from age 30 to age 70, you'll have somewhere around $5 million in your Roth IRA. People impulse a big purchase like a car. That makes you stupid. You don't impulse that. You study that. And then pay cash, of course. Now, most of the time paying cash means that you are doing a bank transfer, but sometimes you can walk in with the cash and just lay it on the table. It's not that much money. I mean, $7,000, $10,000, $15,000, whatever. It kind of blows a dealer's mind, but certainly if you're buying from an individual, when you put cash on the table, it says we have a deal. It doesn't say, oh, I need to check with my banker.
Think financing a car purchase at low interest rates is smarter since you can invest the money instead? Well, not so fast. Here's a real doozy. Ramsey advocates paying cash outright for all vehicle purchases, even if auto loan rates are dirt cheap. Talk about counterintuitive. Dave's reasoning here centers around debt freedom and the psychological power of ownership. He explains when you finance a car, monthly payments feel like deadweight obligations that never disappear, since interest constantly accrues. You never own the asset outright. Whereas when you pay cash up front, that purchase weight gets lifted off your shoulders for good right away. Yes, plopping down $15,000 or $20,000 hurts temporarily, but once that title transfers over, you own that vehicle free and clear, which feels empowering. No lingering note hanging over your head. And since cars are depreciating assets that go down in value, Ramsey sees no point going into long-term debt for something guaranteed to decline in worth. You want ownership of liabilities that lose value quickly, not debt. Now, obviously, most people buying a $30,000 car don't have 30 grand chilling in their checking account. But that's why Dave tells people to save up and pay in actual cash, even if that means purchasing a far cheaper used ride. While definitely an extremist stance, hopefully you can now see merit in Ramsey's anti-debt perspective on vehicles. Test drive that psychology of full ownership by handing over pure cash. Number 5. Don't buy a house without putting down at least 5%.
Then when you get ready to buy a house, put as much down as you can put down. If you put down 20%, it'd be ideal because you can avoid PMI, private mortgage insurance, which is merely foreclosure insurance, that if you get foreclosed on, it pays the mortgage company if they lose money on you. If you put down 20%, you don't have to buy PMI, which is useless to you. It's a favor you do for the mortgage company because you didn't put down enough down payment. Put down 20%, you avoid that. It's about $75 a month per $100,000 borrowed. It's $150 a month for a $200,000 mortgage for your PMI. So I like for you to put down more than that. I don't yell at you if you don't, but I will yell at you if you violate this next one.
Ready for an eye-opening view from Dave Ramsey? He urges against buying a home until you've saved at least 5% for a minimum down payment, preferably 20%. This advice clashes against mainstream guidance, rushing first-time buyers into houses with 0 to 3% down loans. But beneath Ramsey's cautiousness lies wisdom about motivation and risk. Regarding motivation, Ramsey explains diligently saving up your own hard-earned down payment money over years cultivates more pride and connection with the home. That house represents achievement through years of lifestyle sacrifices. The process carries meaning. Whereas when banks or families gift you down funds to hurry into ownership prematurely, complacency can breed. The stakes feel different owning an asset dropped on your lap, no sweat equity involved. Now for risk management. Sufficient down payments provide equity cushions against ending up house poor later or owing more than selling brings in. With at least 5 to 20% down, market dips won't instantly sink finances. Is 20% down attainable for average first-time buyers nowadays? Often no. But Ramsey says have patience saving up something substantial before signing mortgages. Otherwise, budgets strain quickly when rainy days hit. While certainly shocking advice, hopefully you now see merits behind Ramsey's down payment directives before buying. Motivation and financial cushions blossom through delayed homeownership gratification. Well, that wraps unconventional perspectives from Dave today. Please share your biggest money takeaways below and stick around for more oddball financial wisdom next time.